Welcome, everybody, to another episode of Passing Notes. I'm Bob Repass, and again, I'm joined by Chaz Guinn. Chaz, today I thought we'd talk a little bit about the housing market, the real estate market, and how it's been impacting the note business. A lot of times people don't really see the correlation between the note business and the housing market, and I wanted to kind of speak to that. And we have our first in-house guest joining us on the podcast today. Chaz, why don't you introduce him?
I almost feel like it's about time. We have multifaceted approaches of how we not only acquire portfolios, but how we dispose of them. And let's just say 2/3 of what we do is going to be a traditional credit, work with your servicer, see how we can modify you, see how we can potentially keep you in your home and repaying on the mortgage. But very often we kind of come across homes that are sitting vacant. They're located in a national footprint where we're located here in DFW, but there could be properties that are in Seattle, Washington, or in Connecticut that we need resources to, and we need to be able to not only get in the home, but figure out what our strategy is going to be in terms of disposing it. How are we liquidating it? And now we want to kind of get into the nuances of what that really actually looks like. So, our in-house guest has now been with Revolve for well over a year, and he's been not only a fourth-generation Texan, but also being able to help us not only expand our resources here locally, but actually helping us do it in a national footprint, especially as the company and the business starts focusing more on vacant properties that we can get to a fix and flip, foreclosure, rental type of strategy. So please help me welcome Jeff Wells. Jeff.
Thanks, guys.
Thanks for not only being here, but helping us kind of dive into a strategy that we've been really rolling up our sleeves on and having some fun with. And maybe you can give a little bit of the audience of not only your background, especially on the fix and flip, the rental side, the actual ground up construction that you have been doing, but how are we now applying that level of experience to what Revolve is kind of focusing in on. So give a little bit of taste for that.
Yeah, so I've been in the real estate space for about 10 years, more on the what you call downstream, the physical real estate space, either fix and flips, land development, vertical construction, more single-family home focused has been my background.
Mm-hmm.
So as we're building up that same strategy here at Revolve, there's definitely meat on the bone that we see in notes. And so very selectively, pinpointing local, regional, and national homes that we can add value to, either exit that on MLS and sell the home or keep it as a cash flowing rental.
A year plus ago when you and I first kind of started looking at locally, what were we seeing in terms of supply? How much supply was here? We saw less than 3 months supply in DFW. It almost felt like the minute a for sale sign went up is the minute it went under contract until rates began to continue to uptick. And we started seeing kind of a constraint in financing, right? So you had your first-time home buyer or even your second or third-time home buyer that was looking to potentially downsize or even move from California to DFW or move from kind of a migration from New York to Florida, right? We saw the supply not only being constrained, but the financing that was tied to it actually getting even tighter as rates began to continue to uptick closer to 7%. Today's rates we're starting to see closer to 7.5%. Did you see kind of the different makeup of the buyer that you were putting on the market as your own fix and flipper and doing not only your ground up construction, but who was your buyer? Who could, afford, today's financing?
Right. I would say the buyer has been unique. It has not been, at least in the DFW market with the projects that we've had, not your traditional retail buyer. Investor buyers, insurance agencies, people moving from out of state, retirees moving out of the country back into the city to be with grandkids. So it's been unique. The pressures in the marketplace are also at a local, regional, national level, unlike what we've ever seen before.
Mm-hmm.
We have potential for high demand. In some cases, the market's a buyer's market. In some cases, a seller's market. So I think because of that, the shift that we're taking here, or the focus at Revolve, is really affordable housing.
Mm-hmm.
Interest rates right now are historically high. Mortgage payments are historically high. Probably not a realistic rate reduction happening until end of this year, into spring next year.
Mm-hmm.
And so because of that, our buy box and our due diligence is really focused on ARVs of $500,000 or less. That's after rehab. So we're looking at properties that we can acquire or go through foreclosure on a note, add value, a full touch cosmetic rehab, and then exit that home at less than $500,000.
So we like that window. We feel like that's going to serve today's American buyer, right? You've got this high-end market where we're already seeing the constraint in the high-end market. There's very little supply in the market of $250,000 and less, more of your rural asset. But that $300,000 to $500,000 bucket mean you were talking macro numbers, and we saw 4 to 5 million homes would need to be built to be able to keep up with supply. But me and you were looking at saying the way to stoke supply is to tap into the foreclosure, the real estate, the distress side of the market to be able to help stoke some of that supply that's been clearly constrained. So, we were talking to Jeff about HECMs. You have talked about it in prior episodes. How are we going to be able to tap into the HECM space when it comes to fix and flip, when it comes to vacancy, when it comes to being able to really expand a portfolio of homes that today we're starting to find is an untapped market of supply?
Right. And just so everybody knows, HECM is a reverse mortgage. So it's made to someone 55 and older and basically created to default upon death, right? Which at that point in time, you're going to have a vacant secured property, basically dealing with the heirs to that property to decide whether or not they want to sell it or if they wanted to go through the default management process. And that's where we're looking at a large uptick in these mortgages now as people, my age and above start getting to the point where, okay, they're at the point where they've passed away, and now what's going to happen to that property? So that's where we'll call it off-market inventory can be found. And I wanted to hit a little bit on Jeff's point on the affordability. Because we talked about rates pushing 7.5%, prices still going up because the inventory is low. We are at an all-time high of a monthly mortgage payment. The average mortgage payment right now is $2,890 based on the average median sales price, right? So that's P&I, principal and interest, right? Almost $3,000, right? Well, what part of the market, the buyer's market, does that eliminate from an affordability standpoint?
Masses. Yeah.
Right? And that's to just point about all these people. Okay, so we have people from California moving to Texas. We have people moving to Tennessee. We have people moving to Florida. But there's a lot of markets people just aren't moving to.
Sure.
They're moving away from. Right? So how is that market going to be impacted? Right? And, you and I were talking earlier. You get someone like myself who is an empty nester. My wife and I, lived in our house since it was built in 1998. Raised our 2 kids there. Now they're grown adults out on their own. My daughter lives in D.C. My son lives here in Dallas, but travels a lot. And all right, we're going to downsize. Right? We had a realtor reach out. Hey, we want somebody who wants to live in your school district. Would you be interested in selling your house? And our immediate answer was yes, because we have a ton of equity. Right? And then after about 2 seconds, you're like, "But where am I going to go?" Right? And then how would I afford it? I'd take all my equity out and I'd have to have a 7.5% mortgage somewhere. So we're, like they say, we're locked in.
So then there goes the ripple effect of lack of supply, right? So this is where we're saying, okay, yeah, we understand that it's not going to come from your traditional markets, but it can come from the auctions. It can come from the HECM space. It can come from the bridge and fix and flip space where everybody was going on a craze for rehabs from 2020 through, call it last year, when rates started to skyrocket. And now you're starting to see business owners who took out a bridge loan that have now gone 6 months, 8 months of default, that now have no intent to cure that balance, that now can kind of come to us to either finish the rehab ourselves or to be able to create some alternative ways of how we're going to exit that file. Jeff, I think you've seen kind of a definite uptick on national firms that are able to help us kind of reach a kind of a more of a masses in terms of a scale. Sure, we have a footprint here locally. We have a footprint in the Midwest and the Southeast.
Right.
But as we expand, we don't have to specific, but what are you tapping into regarding resources to be able to help us, tap not only Seattle all the way to Connecticut, all the way to San Diego and Miami? How are you helping us, expand that?
It definitely starts with the actual MLS listing agency. I usually start with them. So as we're evaluating properties, we've partnered with a national agency that can get agents boots on the ground to evaluate properties, run comps. So we can be at our desk here in Dallas, and we're looking at properties in Nashville and Boston and Chicago. So that's the first step. So we're going through our due diligence process to see if this property checks as one that makes sense for us to add value to.
And you're getting boots on the ground. You're getting that property locked, secured, scope of pictures taken. Walk us through a little bit about, the nuances that you're going through to fully rinse a property.
Absolutely. So it ties into to the selling agency is involved in it for sure. They're also going to know local rehab contacts potentially. They're going to know cleaning crews and yard services, and their incentive is they want the listing agreement so they can make money on the sale as well. We also have the same agency in place if we choose to keep it as a rental. So they can be the agent on a rental property also. As it goes through the criteria in our due diligence process, going through the rehab itself, one variable I wanted to bring up in terms of affordability, and this is a tougher metric to pinpoint, but I'm seeing this myself the last 2 years as interest rates have gone up in the sevens. There's affordability issues even with home buyers that they want to buy homes that are fully rehabbed because they don't have the money. Once they buy the home, they don't have the money to finish out remodels. They don't have the ability to add a new roof or add a new fence. And so our approach to rehabbing is we do a full touch rehab where we're touching everything on the house, internal, external, down to switches and plugs, because we want the house to be high quality, move-in ready, go through the inspection process very, very cleanly, so we don't have to go back to another property and spend 2 weeks on blue tape repairs. Mm-hmm. So that is something that we've been very sensitive to, making sure that the properties that we are rehabbing under the Revolve Capital umbrella are very well done and fit the criteria of affordable housing, entry-level housing. That's also very important right now with interest rates high, construction costs are high. There's a high cost of owning a home. Everything about owning a home is expensive.
Let's forecast just a little bit, right? We're in a higher interest rate environment. Me and you've talked about in prior episodes, the election year is going to have a real staying power into what, the psyche is in here in 2024. But let's just guesstimate. There could be a potential administration change in the latter part of this year. And whether you like the guy or you don't like the guy, it's more about policy. All right. And how does the administration look at foreclosure policy and supply policy and rates? And how does that directly affect the consumer? Do you see the demographic changing of buyer as rates begin to soften and demand begins to uptick? What do you now forecast in terms of an environment if rates start dropping into the sixes, potentially even touching the fives? Do you find that may stoke kind of a whole new wave of demand in the market?
Absolutely. And I think from our standpoint, we want to be smart about what properties we are touching. We're talking properties in good metro areas, good school districts, in locations and states and regions where people are wanting to move to. I think those are all criteria. In 6 months, we want to be ready for potentially rates to come down and demand to go way up. We don't think prices will come down, though. We've had a pent-up demand for quite some time, but we're very, very focused on making sure that as we're taking down properties into rehab, that they're in highly desirable areas. Again, back to the $500,000 ARV price point, highly desirable areas in good school districts, in metro areas where people want to move to.
We're here today talking about the housing market and its impact on the note business. And be sure to like this episode and subscribe so you see future episodes of Passing Notes. And Chaz, Jeff was just mentioning some of the affordability issues and the markets that we target. And you and I, we look at a lot of deals that come across trade desk, right? And we can look at 1,000 assets and we decide we want to bid on 400 of them. And we kind of go through that process of, okay, if this is a distressed asset and we're going to end up owning it, in which particular markets do we want to own? So kind of walk us through like how we would go through a filter and a funnel from 1,000 down to 400 and then perhaps closing on 350 of them.
Yeah, absolutely. I think that the way that we hedge it is if the asset didn't sell on the market, open market, especially if financing is high, and my traditional buyer is not going to be your first-time home buyer, and it could be potentially an investor. I want to be in a market that is not only highly populated, but I know that has a demand for rental, right? I don't want to be buying real estate or foreclosing on notes in markets that have a low population and a very low demand for rent, right? So you don't have to be in super sought-after Nashville, DFW, Miami, Atlanta, these traditional markets that folks want to be populated in. But we'll look at Gary, Indiana, We'll look at a Columbus, Ohio. We know that the rental demand is very strong in the event that financing cannot be used by today's first-time home buyer. So we will kind of filter the process down, and we've talked about it in prior episodes where we've got a kind of a football mentality, right? When we look at an offense, a defense, and a special team strategy. So offensively, if we know we're going to be in a market that the foreclosure is going to be far too long, it's low populated in dense locations, rentals not strong, the cost of our capital to be able to wait out the foreclosure doesn't outweigh the risk and reward, we may play an offensive strategy and trade that asset quickly. Defensively, if we know that there is an ability to get those delinquent homeowners back on track, they've only been 6 months, 9 months, 8 months behind their payment, and the ability to them to reinstate and cure the loan and start paying on a regular on-time basis is high. We want a defense of those. We want to hold those assets for cash flow. But when we start looking at the special team strategy and we start filtering down a large 1,000 loan tape, $300 million in value, to bring it down to maybe $100 million in value, maybe 400 to 500 assets that we're going to now hone in on to acquire. I want that certain portion of that book to be in markets we want to be in. I want to be able to verify the foreclosure is far down the road that I still don't have to have our capital tied up for a year, 2 years, or longer just to get to the foreclosure. But also, can I have financing not only available to the rehab, but do I have a market now to retrade the asset to? And I say retrade, list, sell, have agents that actually can be the boots on the ground for us there. But we have seen that that end buyer has not been your first-time home buyer, your son who's potentially moving to a Boston market and now looking for a home to potentially, have his family reside in. And now he has to go out to his agent and get a 7 3/4 payment, right? That he traditionally would have had to pay $3,100 on a P&I payment, that now he's now paying $5,100. That is a noticeable, meaningful difference in today's everyday person in their pocket. So these are some of the metrics we're using to not only filter down, but you're starting to look at, yes, we know you have to tame inflation, Fed, right? We know you have to calm the consumer down because consumer price index is still at an all-time high. People's spending habits have been zero changed almost since COVID. And this is what's kind of driving a little bit of the behavior of keeping rates where they are. It almost sounds counterintuitive to tame inflation. You have to have folks almost go out of work. Right. Folks have to stop buying stuff to be able to actually lower the cost of goods. So that being said, that does play into, our market, Bob. You're starting to look at what's the behavior look like? How do we get the American dream of owning real estate and be able to create real immense value to stay alive? And this is where we find, we saw about a decade ago, Jeff, we saw Colony, Invitation Homes, a lot of these big block rental companies that own a lot of institutional grade single family homes as rentals. We saw them come into our space, buy the non-performing loan that was delinquent and vacant, finish the foreclosure out, and then turn that entire book into a rental strategy. It seems as if when you're going into kind of that mentality of what are we going to do in terms of disposition, right? What's the timing of it? It almost seems like we're hedging it. We're going into it with a full doorknobs to floors to roofs to lawn maintenance to eventually get rid of it and saying, if this doesn't sell, we're still okay renting it. We're still in markets that we want to be in. It almost feels like it's a win-win in either way. Sure, we want to dispose, but it also looks good in terms of a rental math. Have you approached your business even prior to the Revolve line when you were looking at fix and flips? If it didn't sell, was a rental still an okay strategy for you as an investor?
Yeah, from a rehab standpoint, we're the exact same execution of rehab is going to take place whether we rent or sell it. So it's just a smart play in terms of the materials we're using, making sure that they're appealing to the masses, that they're not overly designed, overly artistic, let's say. So yeah, that is something we take into account. I would say more from an investment standpoint, we're looking for the highest exit. So if interest rates really pop and go high unexpectedly, like they did when the Fed raised rates 11 times in 2 years, that changed the mentality of a lot of the way that fix and flips are being managed. Same thing if Feds do reduce the rates. It's going to be an onslaught of buyers. We're probably having people line up down the sidewalks again. Mm. And so the best return for Revolve Capital or investors may be to sell that home and rinse and repeat.
Yeah. And I want to circle back to the reverse mortgage piece. And, we have private capital funds that are invested in these HECMs, and if you would like to learn more about that, you can go to revolvecapital.com. But you brought up an interesting point because, Chaz, back in, let's say, 11, 12, 13, people were buying REO and distressed debt and basically, putting lipstick on a pig and saying it was rehabbed, and there you go. And that really wasn't the case. People were getting properties that, had some serious issues with them. And the approach we're taking in the reverse mortgage space that Jeff mentioned earlier was we're taking a full rehab. And part of that issue is, if you think about what product you're getting, if you're getting a reverse mortgage through foreclosure, you're getting a house that's probably aged, right? An elderly person lived there until they passed away. Now, I'm not going to say every one of them has shag carpet and green appliances, but they're probably not up to date. And we're taking that property in a good market that we like, and we're doing that full rehab. And the only way we're able to do that, Jeff, is, like you said, is to be able to have boots on the ground through national vendors, right, that you manage those relationships for us.
Exactly. Yeah, that's right. I was also going to make a point too, Chaz. I think because of the passive investors that are with us at Revolve Capital, a lot of the folks I brought in from my own contacts are people that touch real estate. They're people that do land development. They do construction. They do rehabs. And maybe they're wanting to invest with us passively just to take a break. Is some of what I've heard. The last 2 years in the marketplace has been a lot of work and stressful for a lot of fix and flippers, having to hold properties longer, more expensive construction cost, properties not selling because rates are high. So a number of investors with us over the past year are very, very familiar with rooftops and real estate. And so I think being able to speak more to this is really resonating with some of our most coveted passive investors. They're new to mortgage note investing, but they really get physical rooftop investing. And so they like to see a certain part of our book is being taken downstream and value added and a maximum exit taking place. So I think this whole discussion is really resonating a lot with a lot of our newer investors.
We always talk about if you're going to raise your own fund or run your own conference or run your own distressed platform, trading platform. Guests that we've had on this podcast before is they've all been first person doing it themselves. Let me cut my own teeth. Let me kind of work through a little bit of the nuances of the business before I now start bringing friends and family and my network into the space. And so I feel like you're no different, right? You've been able to not only cut your teeth in doing your own fix and flip, your own sod and lawn maintenance yourself, right. But to now being able to be in a suit, in an office, and now overseeing crews that do all the grunt work. We've got live fix and flips going now.
We do.
We've got stuff that's been really pinpointed from kind of a day 1 to a day 90 turn before it now gets put as a property listed. How many properties that are now being actively worked for us are you actually physically touching now?
Yeah, so we have a couple of rehabs that are within the last 2 weeks that are finishing up here in the DFW Metroplex.
But are you getting dirty? Are you getting in there?
Absolutely not.
Yeah.
Actually, even the ones that are local here in Dallas, I'm pretending they're out of market because I really want to, test our team of resources. Really, because in some cases these resources I'm using regionally, nationally. So if a house is 20 minutes from here, I want to pretend that house is in Nashville, Tennessee.
Yeah.
So speak a little bit as the impact technology has. Mm-hmm. Right, videos and photos, and how we're able to basically see real time what's going on with that property that maybe a year or 2, 3 years ago we weren't able to do.
Absolutely, yeah. I would say the most distinct difference is our GCs have apps. I get text and emails of daily videos of progress on properties, pictures, and so forth. As we're watching the budgets and the time frame, the exit plan, our guys that are in the houses doing the work, coordinating with the local agent to map out when pictures are being taken, when the cleaning crew is coming, when it goes on MLS. And so all that's being coordinated from the Revolve headquarters office on a national level. It's exciting to see how fast it can move.
It's such a game changer, not only from a tech perspective, but from a transparency perspective, to feel like you're in DFW, you got crews in Columbus, you got crews in Nashville, you got crews in Flint, Michigan, right?
Right.
But I'm seeing real time what's happening on the properties. They're telling me, they're showing me the before and afters. I'm seeing those real time. That didn't exist in our space a decade ago. So if you look at where it was to where it's at now, can you imagine the AI component now being brought in? We're seeing guys that are sticking, Ring, doorbells, on property, so you can see who's at the crew, what time they got there, all these transparent modules that we didn't have as property manager and as asset managers, right? To be able to get crews, local boots on the ground, folks that can help us churn and burn properties that didn't exist a decade ago. This is where we're kind of not only getting excited about real time, but now how many projects can we now have going at once that we don't have to physically be there to be able to help churn and burn the property. That's key.
Did you say DoorDash? So
I must be getting hungry.
I was going to say, so we even feed our crews lunch while they're working. We just send them DoorDash, so that's great. No, as we wrap up, I wanted to kind of bring it back to, we work hard, we play hard. We talk a lot on our podcast about, stabilizing neighborhoods, the win-win for the homeowner if it makes sense and everything. But one of Revolve's core values is also just to give back to the community. And, we're participating in a local charity golf tournament as one of the sponsors. 3 of us will be playing with one of our vendors, and we're just there just so people know, like a lot of times, these guys are real estate investors and, they take all this money and go do whatever they do. And it's important that we're able to give back to the community and just for folks to know they can rely on us, not only where we live in our community, but in the communities where we're buying assets, right? To Jeff's point, we're not just putting lipstick on a pig and throwing a house back out there. We're fixing that up, which adds value to that property, to the tax value of that property, to the community and the neighborhood that it's in. So, one of the strengths I feel like we have at Revolve Capital is our commitment to that give back to the community.
Love that you brought that up, especially that we're going to have a stick with us that he played college golf. Doesn't also hurt. But I will kind of highlight that a little bit is that we have yet in the 12, 13 years that majority of us have been in management team and the 15,000 plus assets that we've been able to acquire, we have yet to have to dispose or disposition a family from the home, right? That's not a win-win for them, nor is it a win-win for us as a company. We do want to be able to help revitalize communities and be able to find a win-win solution, not only for the delinquent homeowner who's going through God knows what regarding potential death, cancer, job loss, COVID, many of these major headlines that cause you to fall delinquency in the first place. But more importantly, here in DFW, we want to be local to our communities because we are helping some of the more rougher looking properties become some of the best looking properties in their neighborhood. But we're doing that on vacant homes. We're not having to do that and just do that by way of disposing of a family. So that being said, we are about a win-win solution, especially if somebody who hasn't made a payment in years and stuff we've shown you in prior episodes where folks have been able to not only tap into a state government assistance to be able to bring 35 payments of themselves current. They had almost gone 3 years of delinquent and now have been able to be brought current. So we are going to be joining Keller Charity Services. The information's below on your screen to be able to say, look, we want to get out there and be a part of our community and help folks that are actually potentially not only falling behind, but also potentially looking for an investment alternative that can change the potential course of their family. So we're excited about being involved in that.
Outstanding. So if you want to learn more about being a passive investor with Revolve, go to revolvecapital.com. Jeff, thanks for joining us today. Chaz, as always, it's been great. And be sure to like and hit that subscribe button for the next episode of Passing Notes.